We just got some new economic data which has Wall Street and economists excited. Earlier this week, we got a new economic report which said that not only is the economy in the United States growing fast, but in the second quarter of 2024, it grew faster than expected. Then later that same day, we got the new unemployment report, which said that new unemployment claims in the United States have now fallen to the lowest numbers we have seen since May of 2024. And these two pieces of economic data together got Wall Street excited, it got economists excited, and we saw the stock market rise with that. So what I want to do in this video is go over three things. Number one, I want to go over the economic report. What is it talking about? And then more specifically, I want to go over some nuances that I think a lot of people are completely overlooking. Number two, I want to go over how this ties into inflation. And number three, I want to go over how this ties into interest rates. So let's break this all down. And I apologize for being one day late on this video. I've been in Manhattan doing some podcasts, so I got a little tied up with that. Our economy is measured through a number called GDP. GDP is a measure of all spending that happens in our economy. But the question I want you to ask is who's doing the spending? Now, we all know that consumers do the spending. Like if you go to Chipotle and you buy the extra guac, that contributes to the GDP. We know that businesses do the spending. If Chipotle, the company, goes out and buys avocados, that contributes to the GDP. But there's one more entity that is contributing to the GDP that you want to pay attention to, and that is our government. And the reason why this matters is because, of course, the government generates tax dollars from taxpayers, but the government can also spend money that they don't have. And this is what you want to pay attention to. Let me read you the numbers. In 2019, the United States government spent $983 billion they did not have. That's called the national deficit. The national deficit is spending money you don't have. So in 2019, the government spent almost $1 trillion that they did not have. I want you to remember that number. In 2020, the national deficit jumped up to $3.1 trillion. That was the pandemic. In 2021, the national deficit was $2.7 trillion. Again, pandemic time. 2022, post-pandemic, the national deficit fell to $1.3 trillion. But then in 2023, the national deficit started to rise again. The national deficit went up to $1.6 trillion. And in 2024, the national deficit is expected to be $1.9 trillion. Why does that matter? Because 2024 is expected to have the third largest national deficit in history, second only to the pandemic times, which means the government is spending almost $2 trillion in our economy, in our economic system, to do a whole bunch of things, which stimulates the economy. It contributes to the GDP, it contributes to the economic growth, but this money is not coming from tax dollars. This is money that the United States is borrowing. Now, of course, there's a cost to this, which I'm going to discuss in just a second, but this is contributing to the GDP in our economy, and so I want you to understand that, which brings me to part two. How does this tie into inflation? Now, of course, we've been covering all of this in Market Briefs. Market Briefs is my free financial newsletter, where every day my team is breaking down what's happening in things like the economy, the stock market, the housing market, the crypto market, and the global economy. It's completely free, and if you have not joined Market Briefs yet, well, what are you waiting for? Because if you don't love it, you can unsubscribe at any time, and I got the link for you to join Market Briefs down in the description below. So if we go into inflation, the thing that I want you to understand here is a lot of people have been talking about how the Federal Reserve Bank has beat inflation, which is why we are now in this rate cutting cycle. The Federal Reserve Bank is now cutting interest rates, but there's a couple pieces of data that I want you to understand on this, which is the inflation rate versus the cumulative inflation that we have seen. The rate of inflation that we are seeing today is lower than where we were in 2021. If you remember, a few years ago, we had that 9 or 10% inflation, which was very high. Today, we're around that 2.5% number. Now, although the rate of inflation has fallen, that does not mean that the prices of things have fallen. It means that the prices of things are rising less fast. And the reason why this matters is because we have seen disproportional inflation on some items over others. Again, let me give you some numbers. Between 2019 and 2024, household income grew by around 17%, but I'm going to round that up to 20%. So over the last 5 years, let's say household income has gone up by 20%. Between 2019 and 2024, reported inflation is 23%. Between 2019 and 2024, reported grocery inflation is 27%. Between 2019 and 2024, median rental prices have grown by around 50%. Between 2019 and 2024, median house prices have grown by around 55%. And between 2019 and 2024, the stock market, the S&P 500, has grown by around 80%. This is why I want you to understand this. Because yes, the rate of inflation has fallen. However, just because the rate of inflation has fallen does not mean that it fixes the cumulative compounding inflation that we have seen over the last few years. The median household income has grown by less than 20% over the last 5 years, which does not keep up with the reported inflation numbers. It does not keep up with the grocery prices. It does not keep up with rental prices or housing prices. It does not keep up with the stock market, which means that the average investor has become disproportionately wealthier over the last 5 years. The average American who is not an investor, which is the average person, has become poorer over the last 5 years. So now we talk about, well, the economy is better, the economy is strong, inflation is no longer a problem, we're cutting interest rates. I want you to really understand what this means, because there are clear winners and losers in this economic system. And as unfortunate as it is, I want you to understand how you can be a winner, because the reality is it is up to you to take care of your finances and your money. Cutting interest rates, it just impacts debt. If you are sitting on cash, the only change that this makes is it lowers the yield that you're going to get on your cash. So if you have money sitting in a high yield savings account, well, the interest rate that you're getting is lower on that. The reason the Federal Reserve Bank cuts interest rates, I'm not just talking about right now, I'm talking about historically over the last 100 years, the Federal Reserve Bank cuts interest rates as a way to stimulate the economy, as a way to spur spending. Now, when we talk about stimulating the economy, that does not mean stimulating your bank account. Stimulating the economy means getting people to spend money, but more particularly, they want people to spend money with debt. That's what interest rates do, because lower interest rates make borrowing money cheaper. If you can borrow money cheaper, it's easier for you to get a car loan. It's easier for you to take on more debt on your credit card. It's easier for you to get a mortgage, get a business loan, whatever type of debt that you want. Lower interest rates make it more accessible and makes it more cheaper. So when you talk about the Federal Reserve Bank now trying to stimulate the economy, well, lowering interest rates is why they do that. But the reason why I want you to understand this is because, well, the data just says that our economy is growing fast, and it's growing faster than expected. If we take a look at the second quarter economic numbers, it says that from an annualized perspective, our GDP, our economy is growing by 3% a year. In addition to that, the unemployment numbers are coming in lower. So then what are we trying to stimulate? Well, if we're continuing trying to grow the economy faster, lower interest rates make borrowing money cheaper. Why does that matter? Well, let's take a look at the state of debt in America. If we look at the consumer level, consumer debt is at an all-time high. And we're not just talking about fixed rate mortgage debt, I'm talking about credit card debt. We have a record high amount of credit card debt in America. Many Americans are now maxed out on their credit cards. We have the highest auto loans in America ever. We still have the student loan problems, and now we want to make borrowing money cheaper to make it more accessible for people to borrow money. Okay, that's fine. Let's take a look at corporate debt. Corporate debt is also at the highest levels ever, and the corporations that have adjusting debts, which are pretty much every corporation, a commercial landlord, have been putting a lot of pressure on the Federal Reserve Bank to cut interest rates, because every corporation and commercial landlord readjusted their debt in 2020 and 2021 when interest rates were at their lowest levels ever. And in 2024, we're now starting to see this corporate and commercial real estate debt start to readjust, which meant that debt payments were about to go up. So you can imagine why there was a lot of pressure on the Federal Reserve Bank to cut interest rates because of that. And then on top of that, we also have our national debt. The United States government has close to $35 trillion worth of national debt, which is the most amount that we've ever seen. And of course, the government has to pay interest on that. And so when we cut interest rates, the goal is to stimulate spending, but more particularly stimulate borrowing money, which then stimulates spending. And the question is that a good thing or bad thing? Well, it's good for the economy, it's good for investors, it's good for me because it helps my portfolios, But is that good for the average person? This is where I want you to start to think a little bit more as to who the Federal Reserve Bank is helping and how you can build wealth, because what we know is that inflation disproportionately hurts some people, it disproportionately benefits other people. Over the last 5 years, incomes have not kept up with inflation. It has not kept up with grocery prices. It has not kept up with housing prices. It has not kept up with the stock market, which meant that the average person, if you're relying on a salary, have to spend more money out of your salary to pay for your regular necessity expenses. You have to pay more money for your housing costs, your car costs, and your food costs, which means you have less money left over to save and invest, and asset prices today are higher than where they were before. That's what inflation has done, which is why, again, it is so important for you to build your financial education. But that's why I also want you to understand, well, if we start cutting interest rates, what does that do? Which brings me to the topic of interest rates. If interest rates are cut as a way to stimulate the economy during times of economic slowdowns, what is the reasoning for cutting interest rates today if the economy keeps coming in stronger than expected? And this is where we don't necessarily have answers, but I want you to start thinking about this, because the Federal Reserve Bank talks about how they're cutting interest rates as a way to keep the job market strong, because we have seen unemployment numbers rise. We were at around 3.5% unemployment last year. We're at the low 4% now, 4.2, 4.3% unemployment, which historically is still some of the lowest unemployment rates that we have seen in the last century, but the concern was the rate at which unemployment was rising. But the thing that I want you to think about here is, to tie this all together, if our economy is still so strong and unemployment numbers are still so low, why do we need to cut interest rates? And I think part of the reason for this has to go back to what I talked about in the beginning of this video, which is government spending has been a big stimulus for our GDP and our economy. Government spending has been growing, and it's been a growing piece of our GDP. And if the government spending is a growing piece of our GDP, it can mask almost deficiencies in other parts of the economy. And if that is the case, then maybe the Federal Reserve Bank is trying to stimulate the economy in order to prevent other sorts of economic pains, which, sure, that is good. Nobody wants to go through pain, but sometimes, unfortunately, recessions have to happen as a way to correct bad investments in the economic system. Recessions are a part of our economic system. They have happened every decade for the last century. They are painful. Sometimes people lose their jobs. Sometimes people lose their investments. They're not good in that sense, but they're good for the long-term health of the economy because they act almost like a refresh. And so now, as we enter this interest rate cutting cycle, where there's many talks now of how many other large interest rate cuts is the Federal Reserve Bank going to do? Are we going to see another large interest rate cut before the end of the year? How many more times is the Fed going to cut interest rates in 2025 and 2026? I want you to pay attention to all of this in one kind of big machine where interest rates are there. How is that going to impact government spending? Because remember, it's not just consumers that borrow money. It's not just businesses that borrow money. Lower interest rates also make it cheaper for the government to borrow money. How is that going to impact the economy and GDP? How is that going to impact inflation? Because inflation is a byproduct of the government spending money that they don't have. Inflation comes from the word inflate. What are we inflating? When you have inflation, we're inflating the monetary supply. So when the government has a large national deficit, like in 2024, we are expecting a $1.9 trillion national deficit, the government has to borrow this money from somewhere. And one of the places that the government borrows this money from is none other than the Federal Reserve Bank. And the Federal Reserve Bank is not sitting on cash reserves. In order to lend this money to the government, the Federal Reserve Bank has to create this money, lend it to the government. That way the government can then spend this money in our economy. Now, when we keep increasing the amount of dollars out there, the value of each individual dollar goes down, causing the price of things to go up, which, like we've been discussing, benefits certain people more than others. The financially educated benefit, the financially uneducated pay the price, and unfortunately, the people that don't understand this are generally the ones that are paying the price. That's why I want you to be financially educated and understand how our economic system works. That way you can win in this economic system. Some people want to fight, complain, scream, cry. I want you to understand the rules of money. I want you to understand the rules of our economy. That way you can win in this economic system. And with that, I will see you on YouTube tomorrow.